Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us as we wrap up the day and the week here at AusBiz. And a bit of a fizzer on this Friday. To be fair, it's been a fizzer over the past week or two. We did have a relatively positive session prior, but we're down again today, around 0.25% on the CBO 200. Checking on the S&P ASX 200, it's down 0.3%, or close to a third, at least, with some weakness, particularly in the REITs and consumer discretionary sectors. Should also note we've seen Bitcoin rise by more than 4% over the past 24 hours. It's up 20% over the past week. That's after the US Treasury revealed plans to rein in long-term bond yields. That has also led to debasement fears for the US dollar. We might discuss that with Shane Oliver in just a moment. Let's get to the themes of the day. False dawn, certainly as far as the local share market is concerned, but very much driven by reporting season, some of those big results we've got over the course of the week as well. Guac and roll, that's not a bad one, thanks to Varma, our producer there. That is all about Guzman and Gomez, which is doing very well today after the back of its latest results. We'll get to that. And as I mentioned, Bitcoin bounced 20% this week. It's been a big move, up to about 75,000 US dollars, in fact. All right, let's get to those sectors that have moved. Then I mentioned the REITs. That is the most poorly performing sector on the ASX today, led by Guzman Group, which is off 5%, having already reported this week. Similarly there with SGH Charter Hall is off 6%. Elsewhere, consumer discretionary, another poorly performing sector. Wesfarmers, that's reporting next week, but it is off around 2.5%. JB Hi-Fi reported at the beginning of this week. Harvey Norman, Lovisa, Accent, that was out with its report today, off almost 9%. Premium Investments, Temple & Webster, Nick Scali, we've heard from all of them. Thus far, obviously, we know the pressure the retailers are under at the moment. And tech, that's another one falling into the negative. WiseTech is down 0, Life 360, they're all down. Just getting across the stories of the day then, off the back of those reports for results today. Guzman and Gomez, US exit, pushing it to $26.7 million statutory loss, but record underlying earnings of $85 million, driven by an 18% sales growth there. Has launched another buyback too. Ingham's, its underlying earnings fell 21%, with FY27 expected to remain tough as the poultry producer faces higher feed costs. Also, there is the threat of bird flu, which it has contingencies for. Charter Hall, earnings up 27%, with the property manager targeting another 10.5% increase in FY27 earnings. TPG Telecom, first half profit falling 43%, weighed down by costs from its divested fibre business. Perpetual, the wealth manager, expecting a $63.5 million non-cash impairment after a major client flagged plans to withdraw from one of the international equity strategies. Fisher & Paykel Healthcare, the respiratory products maker, lifting FY27 guidance after a strong start with high revenue and profit forecast driven by strong hospital demand. EQT Holdings, BGH Capital's made an unsolicited $24.75 a share takeover offer, putting the trustee and wealth manager in play. And Digico Infrastructure REIT, the data centre operator's annual loss widened to more than $100 million, and it appointed new co-heads to run the business, while SCX Technologies, the AI infrastructure newcomer, falling sharply. We did just hear from their chief executive after listing, despite pitching its low-energy, air-cooled technology as an advantage in the AI infrastructure race. All right, well, let's wrap up the week then. We are joined by Shane Oliver from AMP. Shane, welcome back to you. Great to catch up as we do. So I guess the big news, certainly stateside this week, has been Operation Twist. It's back on. That's when the Fed monetary policy works by essentially changing that maturity mix, selling short-term bonds, buying long-term. What does history tell us? Does it work? Because it didn't. The bounce on market didn't last very long, did it?
It certainly didn't. I think the 10-year from memory fell. 10-year bond yield fell about 5 basis points and then immediately reversed that. overnight. So not much lasting impact there. And when you look at that chart there, it looks like a lot of noise, but the trend is clearly up in bond yields. I think the history of these things is a bit mixed. The Fed was doing it in 1961. That's where the term Operation Twist came from. I think the song The Twist must have been popular at the time. And then, of course, they did it again just after the GFC in 2011. And it's a way to ease monetary policy because in the US, most borrowing occurs at the long end. So if you can get long-term bond yields down, that, of course, takes some sort of stimulus for the economy there. And, of course, the Fed's not the Fed. This time around, it's done by the Treasury. They're looking at that 30-year yield there. It's been going up quite rapidly. It's at levels last seen 20-odd years ago. Only problem is that the level of public debt in the US as a share of GDP is double what it was 20 years ago. And so, therefore, US interest costs on that debt are exploding. They're now about 14% of US taxation revenue. So that's caused consternation in the US Treasury. They've got the idea, well, we'll buy back some bonds at the long end, replace them with short-term debt. But as we saw, the market initially reacted to that, but then quickly moved on to something else and felt that it wasn't going to be sustainable. Because the bottom line is, unless you marry these interventions with fundamental change, then you're not going to have a lasting impact. And of course, here we're not seeing any lasting impact. Treasury Secretary Bissett was talking about, getting the deficit under control. But Americans are always talking about getting the deficit under control. Unless there's action by the President and Congress, then that's not going to happen. And it's hard to see that deficit coming under control anytime soon, unless there's more pressure from bond markets.
Well, and Shane, of course, we've got our own issues here too in Australia with the government debt tipping over $1 trillion. Good headline number there. Of course, politically, we saw fingers pointed about whose fault that has been. But it does raise that question. When and who is going to pay for this?
Well, it's you and me and everybody else in Australia ultimately pays for it in one way or another, paying down that debt. Or alternatively, we pay for it in a higher interest bill. The interest bill on that debt has been the most, in terms of big picture government spending items, it's been the fastest growing in recent times because of higher interest rates and higher levels of public debt. You go back 20 years ago, we had close to zero public debt, at least in net terms, going into the GFC. Radically different situation today. Of course, our debt situation sounds horrendous at $1 trillion. It's not quite as bad as in the US because our level of debt relative to our GDP is about half, less than half what it is in the US. But still, we do end up paying for it because as that debt keeps rising, every time you run a budget deficit, you end up with more debt. And as interest rates rise globally, as they have been doing for the last 4 or 5 years now, you've got to pay more for it. And that means that it takes up a greater share of taxation revenue. And that's where the problem kicks in because you're effectively chasing your tail. You've got to pay the costs of servicing past borrowings, which means less money left over to spend on things like roads and infrastructure and university education, all those sorts of things. And so that obviously could be a political problem as well.
Now, Shane, also on the data front here, we had the jobs numbers as well as wages. Jobs are certainly a bit of a surprise. What did you make of it?
Yeah, they were a bit on the soft side, but then again, the previous 2 months' numbers were a bit on the strong side. So I kind of think these things bounce around month to month. I'd be a bit reluctant to read too much into it. You do, when you look at that graph there, see a gradual rising trend in the unemployment rate. It's a very gradual one. The precise number went from 4.43% to 4.46%, whereas the headline number is reported as 4.4 to 4.5, which sounds more significant. But I think the Reserve Bank would probably still characterise our labour market as a bit tight. When I look at forward-looking indicators for the labour market, like job ads, job vacancies, business hiring plans in surveys like the NAB Business Survey, they still point to okay jobs growth. Not much of a slowing there. And as we heard from the Deputy Governor on Wednesday, they think that that employment growth still needs to slow further from here. So I don't think it necessarily stops the Reserve Bank hiking again. I think the Reserve would still see the jobs numbers as being quite tight on balance, and therefore we're still allowing for another hike when we look down the track to November. And on the wages numbers, they were relatively benign, 0.8% in the quarter, 3.2% for the year. But we know that the numbers, when they come out for the current quarter, will be quite a lot higher because of those increases in the minimum wage and the award wages that were a lot stronger than they were a year ago.
Now, Shane, when we look at the performance certainly over the past week of asset classes, Bitcoin has led from the front 20% over the past week. What do you actually put that down to? We've also seen gold obviously move higher as well. Is it more recently, I guess, related to what we've heard and what the Fed has done there? And I guess also, potentially, that buyback renews that dollar debasement fear, doesn't it?
It does. It brings that back to life. I think that both of them got a bit overextended going into late last year in the case of Bitcoin, early this year in the case of gold. You had a situation, all those people queuing up outside ABC Bullion in Sydney. So the prices had gone through the roof. There was too much positive sentiment. A lot of investors were long those two assets, and that had to be worked off. And it has been. We've seen a 53% fall in Bitcoin from its high late last year, and we've seen something like a 27% fall in the gold price. So that's been worked off. That's set the scene for a bottoming in prices for these two. Then, of course, there's recently been some signs that maybe the US dollar is starting to roll over again. There's renewed concerns about US public debt being too high and the US budget deficit generally. And so that's seen interest return to these two assets because that downwards pressure flowing from those long positions being closed out has been removed. And in the case of gold, it's up at its 200-day moving average. If you want to get a little bit technical, it's around its 200-day moving average, so it hasn't yet broken out decisively yet. Whereas Bitcoin has broken decisively above its 200-day moving average. And I checked, there's been 4 crypto winters since Bitcoin was invented, and they were periods where Bitcoin fell roughly 80% from its prior high. The most recent one was going into 2022, I think it was. And that was also similarly an 80% fall. This time around, we've had a 53% fall. And I guess the big issue was whether we keep on going and get another 80% decline or whether we break higher. Now, the fact that we've managed to go higher above the 200-day moving average, historically, coming out of those 4 previous episodes, has been a sign that, winter is over. We're moving into spring and maybe summer for crypto. So that is a positive sign. I think it's also a positive sign that maybe, if it's the case, we've already seen the bottom, that Bitcoin's got away with a 53% fall rather than an 80% fall. It's a sign that maybe Bitcoin is becoming more mature, which some would see as a good thing. It's no longer part of the Wild West. There's a bigger institutional involvement in there. It's still very volatile, but it is gradually on the path to becoming a more mature asset. Of course, that also means lower prospective returns over the longer term as well. With that maturity, you don't go down as much, you probably won't go up as much. But nevertheless, that would be seen as a positive sign. And right here, right now, you could probably argue technically that Bitcoin is still going higher.
Probably helps that the leader of the United States makes a lot of money out of crypto, and that takes the rest of the market along with it.
Yeah, that's unfortunately the case. I'd rather that wasn't, because it does put a bit of a smell around it that wouldn't otherwise have been there. And one factor this week was he did make comments to Congress, urging them to pass some crypto legislation. I don't know the details. That may have been one factor.
Yes, it'd be interesting to see how the history sees all of this as once it's passed. Shane, great to catch up as we do for the week. Enjoy your weekend. Thanks for joining us on AMP.
Thank you. Thanks, Adam.
All right, now, feeling hungry? We'll try this for our stock of the day. We looked at Guzman and Gomez off the back of its results today, and our experts wrapped their laughing gear around it. That was Stuart Badloo from TEDCAP and Adam Dawes from Shaw and Partners.
I just feel it's at the moment there's a lot of growth company at cheaper valuation. I don't have to pay a big price for GYG at the moment. It's expensive. It's good growth. It's good, but it just it's illiquid. It's not in any. It's in a small odd index, but it's not liquid. It's expensive. And then that does fade next 12 months. Still not yet that certain. We still got cost of living. We've got higher fuel costs. Just a lot of things that still waiting to be, to be confirmed. There's a lot of uncertainty. So for me, I would probably take profit.
Some of the positives is you talked about that pulling away from the US. I think that's absolutely fantastic. Why would another Mexican restaurant be needed in the US? But they did have some extra costs of around 32.8 million. They were guiding to 30 to 40, so that came in at the lower end of that range. So I think that was definitely a positive. Some of the negatives, though, they are looking for a store rollout of around about 35 new Aussie stores this year, but they have guided to around about 40. So it is going to be a little bit less on that side of things. But I think that guidance is what the market is gravitating to, as well as getting out of the US. For me, I agree with Jim, but I think you should take some profit.
Righto, let's return to the market and look at the best and worst in today's trade then. Beginning with the market leaders, NRW Holdings there up more than 8%. TPG Telecom also reporting today, doing very well. Similarly there with Resolute Mining, in fact, positivity across the gold sector, I should say. Medibank Private reported yesterday, it's done well. Liontown Resources also on that list. Those that have fallen into the red have been led by Zip. Those gains made off the back of its result yesterday, having been unwound substantially, down more than 14%. Similarly there with Telix, which also reported yesterday, down 9%. Super Retail, that was off the back of yesterday's result as well. Charter Hall on that list along with Pro Medicus. And in the small cap space, Cyprian Metals up 17%. Amera also doing well. In fact, it's dominated by what we see in the resources space, and those having fallen into the red include Accent Resources, DGL and Felix Gold on that list. Peter Warren also out with its report today, down almost 9%. So overnight, we expect the S&P Global Services and Manufacturing PMI out of the US, and consumer confidence in the EU. And next week, reporting season continuing, the fourth week, with some biggies there, including PLS, Ampol, Woodside, Coles and Woolies, WiseTech, that'll be interesting, and Wesfarmers. We also get the minutes from the last RBA meeting, and critically, July's inflation read and core PCE price index out of the States. All right, so this is where we're finishing on the SIBO, down around 0.25%, a similar margin there on the S&P ASX 200. For the week, we're down around 0.2%. That is the COB for this Friday. Thanks for watching and listening.